Hi everyone, my name is Yana and today I'm going to present you a presentation on the topic accounting periods and accounting methods. Let's start. Learning objectives, accounting periods, financial and tax accounting methods, overall accounting methods, cash method, accrual method, accrual income, unearned income, inventories, uniform capitalization, and cash flow methods. What is accounting period? An accounting period is an established range of time during which accounting functions are performed, aggregated, and analyzed, including a calendar year or fiscal year. The accounting period is useful in investing because potential shareholders analyze a company's performance through its financial statement that are based on the fixed accounting period. Accounting period types. A calendar year, with respect to accounting periods, indicates an entity begins aggregating accounting records on the first day of January and subsequently stops the accumulation of data on the last day of December. This annual accounting period imitates a basic 12-month calendar year. An entity may also select to report financial data through use of the fiscal year. A fiscal year arbitrarily sets the beginning of the accounting period to any date, and financial data is accumulated 1 year from this date. For example, a fiscal year starting April 1st would end on March 23rd on the following year. And 52-53 week year can be the date this same weekday last fall in a calendar month, or on the day this same weekday occurs that nearest to the last day of the calendar month. All businesses are required to pay taxes and keep accounting records year by year. You automatically choose your tax year when you file the first tax return for the businesses. After that, you have to get IRS permission to change. Sole proprietorship must use a calendar year to report their business income. Flow-through entities, as corporations and partnerships, must adopt tax years consistent with the owner's tax year. C corporations are generally allowed to select calendar, fiscal, or 52-53 week year-end. Accounting methods refer to the rules a company follows in reporting revenues and expenses. The Internal Revenue Service requires taxpayers to choose an accounting method that accurately reflects their income and to be consistent in their choice of accounting methods from year to year. Let's understand the difference between accounting methods. Exist two methods, cash method and accrual method. Cash accounting is an accounting method that is relatively simple and is commonly used by small businesses. In cash accounting, transactions are only recorded when cash is spent or received. In cash accounting, a sale is recorded when the payment is received and an expense is recorded when the bill is paid. The cash accounting method is, of course, the method most of us use in managing personal finances and is appropriate for businesses up to a certain size. If a business generates more than $5 million in annual rules, however, it must use the accrual method according to the Internal Revenue Service rules. Accrual accounting is based on the matching principle, which is intended to match the timing of revenue and expenses recognition. By matching revenue with the expenses, the accrual method is intended to give a more accurate picture of the company's true financial condition. Under the accrual method, transactions are recorded when they are incurred rather than awaiting payment. This means a purchase order is recorded as revenue even though funds are not received immediately. The same goes for expenses in that they are recorded even though no payment has been made. Accrual income. Accrual basis taxpayers have traditionally used the all-event test to determine the exclusion of taxes income for federal tax purposes. Under this tax, income is taxable in the tax year in which all the events have occurred that fix a right to receive an item of income, and the amount of that income can be determined with reasonable accuracy. Some examples of accruals. Let's look at an example of a revenue accrual for an electric utility company. The utility company generated electricity that customer received in December. However, the utility company doesn't bill the electric companies until the following month when the matters have been read. To have the proper revenue figure for the year on the utility financial statement, the company needs to complete an adjusting journal entry to report the revenue that was earned in December. It will be additionally be reflected in their receivables account on December 31. The following accrual accounting examples provides an outline of the most common accruals. Sales on credit, electricity expenses, purchase on credit, income tax expenses, rent paid, depreciation, insurance expenses. Now let's define what is an advance payment. Advance payment is a type of payment made ahead of its normal schedule, such as paying for a good or service before you receive it. The deferral methods provide that an advance payment is included in gross income in the tax year of receipt to the extent recognized in the taxpayer's application financial statement for that year or earned for those taxpayers without an applicable financial statement in that tax year, and the remainder of the advance payment is included in the next succeeding tax year, the tax year after tax year in which the payment is received. Example of payment in advance. Rick received in advance 7,200 payments for the client for monthly landscaping service from December 1st 2019 November through November 13, 2021, $300 a month for 24 months. When must Rick recognize the income from the advance payment for service? Answer: $300 he will recognize in 2019, and the rest he will recognize in 2020, $6,900. There are many cases where advance payments are required. Advance payments are made before receiving a good and service. In many cases, advance payments protect the seller against non-payment in case the buyer doesn't come and pay at time of delivery. Companies record advance payment as asset on their balance sheet. A prepaid cell phone is an example of advance payment. Let's briefly talk about the inventories. Many businesses generate income by selling product they accrue for resale or product they manufacture. When selling, inventory is a material income producing factor using the accrual method, even if the business is a cash method taxpayer. However, a taxpayer needs to use the accrual method to account the inventory if they report average gross receipts $26 million or less for the 3 tax year period ending with the prior to year. Instead, taxpayer can generally treat these purchases of goods for sale as non-incident materials and deduct the cost of the materials used. Inventory's price include the purchase price of raw materials, shipping costs, and any indirect costs under the Uniform Capitalization Rule. Uniform Capitalization Rules mean the methods of valuing inventory for tax purposes that requires the business to capitalize direct costs such as materials and variable costs and then allocate portions of indirect costs that benefits or are incurred because of production or resale activities. Exist several types of cash flow methods: FIFO, LIFO, and weighted average methods. FIFO means first in, first out. LIFO means last in, first out. And the weighted average cost per unit equals the cost of goods available for sale divided by the number of units available for sale. In conclusion, we can say that today we talked about accounting periods that are divided, that have three types: calendar, fiscal year, and 52-53 week period. Accounting periods are created for reporting and analyzing purposes, and the accrual methods for accounting allows for consistent reporting. Cash accounting is in the other accounting methods which recognizes transactions only when payments is exchanged. Accrual accounting is an accounting method where revenue or expenses are recorded when a transaction occurs rather than when payment is received or made. And also we talked about inventories and types of inventories, cash flow. Here are the sources that I use to make this presentation, and thank you for your attention.